Good morning, everyone, and welcome to NYSE TV Live. I'm Kristen Schuller in studio at the New York Stock Exchange. Well, the end of the year rally on Wall Street has taken a bit of a breather to start the week. The Dow did end yesterday's session lower for a fourth straight day, but we are seeing a reversal early on Wednesday, and that is on the back of inflation data. It hit the tape just about 30 minutes ago. It's going to drive the action in today's session, of course, before the Federal Reserve's final interest rate decision this year. That comes a week from today. Let's take a look at what's on tap in today's show. Well, investors, as they parse through that inflation data, and we'll give you the numbers soon. Of course, for the November Consumer Price Index data, Comerica's chief economist, Bill Adams, is going to join me in a few minutes to break down what the numbers mean and how it could impact the Fed's decision. Elsewhere, AI startup Captions was highlighted by Time magazine as having one of the best inventions of the year. The company's chief executive will join me to discuss how he is generating and editing talking videos with artificial intelligence. Then later in the show, my colleague Trinity Chavez will speak with GE Vernova CEO Scott Strazik about some of its latest moves in the AI and nuclear energy space. Well, getting back to our lead story, inflation data coming in as expected. In fact, headline CPI rose 2.7% in November from the same time a year ago. It was up 0.3% in November from October. It did show a tick up from the numbers that we saw in October, but again, in line with economists' expectations. If you strip out those volatile food and energy categories, that's the so-called core price index. That was up 3.3% last month, and it was up 0.3% last month from October. Of course, the Fed's long-term target is 2%, so certainly consumers and the Federal Reserve do want to see inflation continue to inch lower. Well, joining me now with more is Bill Adams. He's SVP and Chief Economist at Comerica. Bill, it's great to have you on the show this morning, and investors seem to be responding well to this inflation data. Why do you think that is?
Good morning, Kristen. I think this is a case of no news is good news. The CPI report was basically entirely as expected. If you look a little deeper into the details, the supercore CPI, that's service prices excluding energy services, excluding shelter costs, we're also up 0.3% month over month. So all of these different measures of the trend in the CPI index showing that inflation, while not quite back at the Fed's target, is behaving better than it was a couple of years ago. There's no sign of acceleration in pricing pressures, and that will be enough for the Fed likely to make a cut at the December decision.
I do want to talk about the inflation picture more broadly, Bill, because there does seem to be some concern in the wake of a red sweep in D.C. that inflation might tick back up. That would be on the back of mass deportations, which could lessen some of the less expensive labor that we see in this country, as well as tariffs raising the prices on goods if those are actually enacted, and tax cuts as well, simply putting more money in people's pockets. How do you factor that in when looking at the inflation picture ahead?
Those are going to be important drivers of how the economy performs in 2025. And the way we're factoring that into the forecast is we're assuming that the economy does continue to run hot next year and runs tight because of this policy mix that, in particular, the tariffs are going to provide more pricing power for domestic manufacturers, provide some upward pressure on goods prices likely in the mid to second half of next year. Other policies, hard to know when they're going to be enacted, hard to know the extent. Congress is going to have a say on some of this. So we're not factoring in really specific assumptions about them, but basically all added up means that the Fed will probably be reducing interest rates less in 2025 than they had been signaling prior to the election. So expecting further rate cuts next year, but at a slower pace than what we saw between September and December of this year.
Interesting. I want to talk about the categories. Of course, it's a goods and services economy, and many people have seen, certainly when it comes to services, whether that's their rent price, what they pay at the doctor office, whether it's for insurance, you name it, those have seemed to be sticky and hard to come down. Is there any relief in sight in that particular sector?
Well, for service prices, one of the big components of the cost of providing services is the cost of labor. And so one subset of those sticky service price inflation is the cost of daycare, the cost of elder care services, food services, so restaurant prices. With wages rising faster than they were pre-pandemic, that has put upward pressure on that category of service prices. But the labor market looks pretty well balanced right now. The unemployment rate at 4.2% has a normal degree of slack. And with that, I'm expecting wage increases to continue, but at a more moderate pace in 2025. And so I think that will take some of the edge off of labor-intensive service prices increases next year. The other part of that is homeowners insurance, auto insurance, where these insurers are passing on the cost of more expensive repairs and replacement of assets in higher insurance premiums. And that I think of as just kind of momentum from the high inflation that we've had in the last few years that will take a while to peter out.
I want to get your take, Bill, on the state of the labor market. Of course, we got the jobs report just on Friday. It did show that hiring rebounded after worker strikes and, of course, some extreme weather that we saw in the month of October. We know how people feel about their jobs and whether or not they're employed does impact the inflation picture because it determines how much they spend. What is your forecast for jobs going forward?
I think we're going to see more job openings in 2025 on the back of kind of an animal spirits effect following the election. Obviously, not everyone got the outcome they wanted in the election, but if you look at a number of business sentiment surveys, like the ISM Manufacturing PMI Index, like the National Federation of Independent Businesses Optimism Index, they're showing a rise in sentiment following the election. And I think a lot of hiring managers are going to be, at the margin making headcount decisions based on how they're feeling. And so I think that will mean a little more risk taking from business and a little more willingness to hire in 2025.
And what does that mean for overall growth? GDP growth?
Right. So GDP growth, I think, is above trend in 2024. We had really solid growth of 2.7% this year, in large part because of continued fiscal stimulus and strong growth on the supply side of the economy. In 2025, I think we're likely to see growth continuing at this strong pace with the boost from animal spirits, expectations of incremental fiscal stimulus. And I think that will mean a continued hot economy. So I'm optimistic for the outlook for next year. I think it's going to be another good year for the U.S. economy.
Certain sectors, Bill, that you anticipate to be big winners amid all of this?
Manufacturing is one part of the economy where, looking at those surveys, they are looking for better pricing power in 2025. And that should help hiring and help a rebound. We've also seen a big drag on manufacturing activity in the last 2 years because the construction sector was weak. And with the Fed gradually reducing interest rates, that should help construction, which should boost demand for construction materials and that part of manufacturing. And then I think we're likely to also see the tech industry continue to outperform. I think the adoption of AI technology, obviously there's a lot of hype there, but it seems like there's also a kernel of real value being created, and a lot of those technologies can be transformative in the IT in our economy, which is a growing sector and penetrates more and more. So I think that story has legs and has a way to run.
Bill, we covered a lot. Thank you so much for joining, of course, on the morning of a key inflation report. That's Bill Adams. He's SVP and Chief Economist at Comerica.
Thanks for having me.
All right, well, stay with us because up next, while everyone looks forward to receiving gifts during the holidays, not as many look forward to the returns. Our retail expert is going to join us with everything you need to know about the process when we come back.
So now, Eric, this year, GIC is celebrating 40 years in the United States. What has this journey looked like for you?
We are so proud to be celebrating our 40th year in the US. In 1984, we opened up a small fixed income trading shop here. And the idea was we were a global investor, but we wanted to be local. And we thought it was really important to meet your partners in the market, get to understand the trends, and be there with the businesses that you're invested in. So we opened up our first office in what we thought was the most important market, the United States. We opened up an office 2 years later in San Francisco. And amazingly now, even 40 years later, we've got 11 offices around the world, and these are still combined our two biggest offices in the world. Along the way, we've also diversified what we do. So I mentioned we started with fixed income investing, but now all of our asset classes are invested here. So public markets like fixed income, public equities, our hedge funds business, but also our private markets, our private equity team, our infrastructure team, our real estate team. And the US has continued to grow in importance as a part of the portfolio. So it's now almost 40% of the overall exposure.
Now, Eric, tell me, what opportunities are you seeing in today's market?
Well, we always say prepare, don't predict. We do believe as investors and long-term investors that you want to be diversified. So if you look at our portfolio, it's globally diversified. It's also diversified across asset classes. But we do like to look for long secular themes. And so two that we are interested in are digitization. So we've seen a long tailwind on technology, and in particular in the US, which has been a real market leader for the last 20 years. We believe AI is a really revolutionary technology, and we're investing in that space in a series of ways. A second would also be decarbonization. We do think the planet is getting warmer, and so there will be significant capital invested against mitigating that. And so over the next decade or two, we do think this is a huge opportunity for firms like GIC that are really focused on investing in these long-term projects, providing long-term solutions.
Welcome back to NYSE TV Live, everyone. I'm Kristen Schuller here in studio. While the major indexes and Bitcoin hit new records this month, so too did holiday shopping. There, of course, is more to the holiday shopping season, though, than just getting gifts. My colleague Trinity Chavez has more. Trinity, good morning.
Hey, Kristen, good morning. And as you mentioned, we're already seeing some new records this holiday shopping season. And according to Adobe Analytics, a shopper spent $13.3 billion in online sales during Cyber Monday and $10.8 billion in online sales during Black Friday, jumping by more than 10% and 7% year over year, respectively. Now, a lot of shopping also means a lot of returns, and retailers are bracing for that surge. Joining us now to unpack these trends and their implications for the retail sector is Gaurav Saran, founder and CEO of the returns management system Reverse Logics. Good morning.
Good morning, Trinity. How are you?
Good, Gaurav. Thank you for joining us on the show. And as you just heard, the National Retail Federation, along with other organizations, they're projecting that 17% of all sales this year will be returned this year, costing retailers about $890 billion. That's roughly a 17% increase. So what do you think is driving this surge?
There's really two factors driving the surge. One, on the side of the brands and retailers, they're determined to make sure the customer experience is really good. And one of the drivers of customer experience is a seamless returns journey for the consumer. So on one hand, they need to make sure that they're offering easy returns for the consumers, making sure that the return policies are flexible. And at the same time, the consumers are attuned to returning more and more product because buying online becomes easy, but they're also losing a lot of the capability of feeling and touching the product. So both of those factors are driving a lot of returns, and I think we'll certainly exceed these numbers.
And according to that same data, the return rate has more than doubled since 2019. How have retailers adapted to manage this growing challenge?
Yeah, return rate has certainly doubled. It was about 7.1 or almost 8% before COVID and before 2019, and now it's hitting almost 17%. those return rates are also even higher for certain verticals such as apparel and fashion. Retailers are realizing that returns are here to stay, and the rise in returns will continue to happen as they drive customer satisfaction. People are easily buying products online. You can get a product at your doorstep within a matter of a day or so. So the returns experiences also become very important to drive that returns journey for the consumer.
But now, I'm sorry to cut you off, but now we're actually seeing more businesses implement restocking fees for returns. So can you talk about that a little bit more and how it's impacting the overall business strategy for companies?
Customers and companies have started to realize that returns is a significant loss to the business. The minute a return starts, it drives a loss, whether it is a loss in profitability. So having an end-to-end returns management system is something that a lot of the companies are investing in. One, to reduce the loss from returns, and two, to improve customer satisfaction. So instead of trying to focus on implementing strategies around, let me put restocking fees in place or let me make returns more difficult, I think the bigger focus has to be more on an end-to-end technology that enables them to find those that profitability somewhere else instead of those policies.
And what would you say these policies, what are the impacts that are impacting customer loyalty and how retailers are balancing customer satisfaction with cost control?
Well, 67% of most consumers consider a negative return policy as a deterrent for them to buy online. And 76% of them are saying something very similar, where they will not buy if they see the policy is not something that is in line with how they're used to buying a product. So retailers have experimented with different parts of the returns journey, but what they're recognizing is making the recovery of the asset as a better area while still not giving up the returns experience. Typically, retailers are finding with a technology platform in place about a 5% increase in net profitability and a 25% increase in customer satisfaction.
And what role do you see technology and reverse logistics playing when it comes to streamlining the returns process for both customers and retailers?
I think for any retailer, recognizing that 17% of your product is coming back, you have to have a technology in place that maximizes the recovery. Because, as I said before, the minute return starts, it is a loss for the business. So by having an end-to-end platform that is looking at the entire journey of the return from a reverse logistics perspective, from how do you make sure can you avoid the return in the first place on the front end? Can you make sure that the recovery is really good, where you can quickly process the item and put it back into stock? Or finding ways to reduce the shipping, or tying into sustainability initiatives so the products are sent back quickly. These have all become very mainstream for most large retailers today. In fact, 68% of the retailers are now looking to upgrade their returns technology as a result of recognizing these trends.
Thank you so much. Again, that is Gaurav Saran. He is the founder and CEO of Reverse Logics.
Thank you.
Now coming up, Time Magazine cast a spotlight on the top inventions over the past year. The CEO from one of these platforms is joining us right after this break.
Fiserv serves fundamentally every American household, largest payment processor and largest fintech in the world.
I do want to talk about Fiserv's third quarter report. It was showing significant growth, and especially when it comes to merchant solutions. Can you talk to me about what you think is fueling this growth and how you expect to continue that momentum?
We had 28% revenue growth in Clover. Our regions outside the US also are growing very strong. Our commitment to small business, our commitment to innovation, along with our e-commerce capabilities. So, being able to serve every household across the US and then in multiple countries has given us great geographic diversity and given us great capability, from the largest retailers to the smallest pizzeria.
And you actually just recently announced your collaboration, your partnership rather, with DoorDash on the Crimson program. Can you talk to us more about that and why this is such a significant milestone for Fiserv?
What we did was create a solution set for DoorDash that allows them to be able to bring a better experience to their drivers, the Dashers. And it's really an integrated approach. It's using a series of products we have. We brought a couple of partners in, both in banking and in some other expertise, but ultimately it's our core product set.
How will this help kickstart Fiserv's expansion into other sectors?
Well, I think in fact it is an opportunity to show how we sit at the intersection of banking and merchant. You know, we are the only property that can sit at that intersection, that we could deliver payment processing, Clover, to a bank.
Welcome back to NYSE TV Live, everyone. I'm Kristen Schuller here in studio. Well, this Thursday, tomorrow, Time Magazine will name its 2024 Person of the Year, something that we will be covering on our show. Well, Time gives out a number of other honors as well, including Inventions of the Year. And one of those inventions comes from the AI startup Captions. It allows users to generate and edit talking videos with artificial intelligence. Joining me now with more is Gaurav Misra, co-founder and CEO of Captions. Gaurav, thank you so much for joining.
Yeah, thank you for having me.
Pretty impressive. Your company's raised $100 million, valued at $500 million. What is the special sauce that you offer in the market?
Yeah, so honestly, it's been an interesting ride for us because all we're trying to do is help anybody be able to create video. So that's everything from recording, editing, and training these foundation models, building the tools that enable people to do that has really, catapulted our growth.
How would someone view this and consume this kind of content?
Yeah, a lot of this content, honestly, the adoption is mostly in the marketing, social media space, right? Like that's closest to the revenue. At the end of the day, a lot of creators use us, a lot of marketing professionals use us, a lot of salespeople use us, and that's where we're seeing like the most growth.
Yeah, I want to hear more about the opportunities in this space. We've heard about a lot of AI partnerships, in fact, just in the past few days.
Definitely. I think it's a very exciting and growing space. I think in terms of video foundation models, we're still in the early innings, really, because if you compare, these models are, they're measured in parameters. So the largest language models today are 10 times bigger than the largest video models. And so there's a lot of catching up to do. And honestly, we're going to see better and better video models, in the future.
Can you quantify the savings for the creator economy that your company provides?
I think it's exponential because, the time saved, the money saved. Imagine a world where, you don't really need, physical limitations of lights, cameras, things like that. You can just generate whatever you want, right? It gives access to a lot more people to be able to create video, share their ideas, tell stories, whatever it is that might be doing.
Your company recently acquired Alpaca ML. How does that help your company reach its goals?
Yeah, so we've actually committed to spending $100 million in New York building AI video research. And as a part of that, we've acquired Alpaca ML, which is a startup which was working on similar technology. And their CEO, William Bushwalter, is going to be joining us as leading our research engineering team here in New York. So that's pretty exciting for us as we ramp up our model training here in New York.
Mm-hmm. How do you think the industry is viewing this type of video?
So it's interesting to see. I think the adoption is slow in like more of the media and entertainment side of things, but on the other side with marketing, social media, the adoption is much faster. And I think what we'll see over time is, there's big questions on the media entertainment side around like copyright and like, training data, is it licensed and things like that. Obviously for us, we train only on licensed data. And so as more of these types of models are developed that are fully licensed, where there's not these copyright concerns, where, you've probably seen a lot of these models aren't very good at generating people, right? Like they generate sceneries and mountains and, lakes and things like that. But when it comes to people, there's like 6 fingers or 4 hands, things like that. So as these things get better, I think we'll see more and more adoption in sort of the media and entertainment side. But today we're seeing a lot of adoption in social media.
And what's the timeline for that in the media space?
I think it could be on the years, maybe.
So we would see a more sophisticated programming.
Definitely, yeah. So I would say from the 1 to 3 year time range is where we would start to see something that's essentially incomparable to like a real recording. It'd be like, side by side, you wouldn't be able to tell. So it's going fast.
How big is your company?
So today we're pretty small. We're about 65 people, but we were planning to hire very aggressively this year into next.
Okay, so to that end, then I want to hear about your own expansion plans if you do have aggressive hiring goals.
Definitely. So we're hiring pretty aggressively in New York. We're looking for people with experience in building these foundation models. We're growing a team here specifically focused on video generation, but we also focus on video editing. So that's another big area for us we're expanding into.
And so what do you see as your offerings expanding here with more people on board?
I think what we're going to see is, much broader product. So not just going into marketing and sales, but even expanding beyond that. We're going to see a much broader user base. Today we're in 180 countries and growing, but we're going to see larger expansion in some of these other countries and more worldwide growth.
How competitive is it to get talent in the AI space?
It's very competitive right now. I think it's like, it's one of those rare times in history where technology is moving really fast. Things are changing very quickly. And there's only a small number of people who really have the expertise, just because it takes time for people to get up to speed to these things, right? These are brand new technologies. They've just been developed. There's nobody out there with a lot of experience in these things, right? They were just made years ago, literally, right? So finding these people, hiring these people is very competitive. I think one of our main advantages here is our focus on sort of the consumer space, focus on talking videos with people, right, and doing sort of both video generation as well as video editing. And these are exciting things for people to work on.
I named one of Time's best inventions of the year, Gaurav. Thank you so much for joining. That's Gaurav Misra. He is the co-founder and CEO of Captions.
Thank you. Thanks for having me.
All right, well, stay with us because up next we will have the opening bell.
If I go back to 2021, it was really the first time in the company's history that we actually had an investor day where we showcased our first essentially 3-year strategy for the group. And it was very clear, very focused strategy. It was really about diversification, about the fact that we wanted to increase the franchise value of our reinsurance business, but we also wanted to get scale and expand on the insurance franchise. Once you have that roadmap and that vision and you have excellent people, it's amazing what you can accomplish. And I look at where we are now, 5 years later, basically. The company has more than doubled in size. Our stock has gone up over 60% over that period of time, better than the S&P. Our book value per share, which is a critical measure in insurance, is also up over 60%. And we have improved pretty much every facet of the company, from underwriting discipline to operating discipline. But one of the most important things we have done is we have created a culture of inclusion and collaboration. That's frankly what allows us to accomplish what I just discussed. One of the great things about insurance is that we have jobs for everybody, regardless of where you come from. But no, I did not think that insurance was going to be where I ended up. I had gone to the Johns Hopkins School of Advanced International Studies for my master's. I have a master's in international economics. I speak 3 languages, and I had a lot of experience in Latin America. So I thought there's got to be a multinational company out there that could use somebody with my talents. But I didn't know what industry, and I didn't care what industry at the time, to be perfectly honest. So I had applied to different companies. And the way I ended up in insurance is my older brother, who had worked for McKinsey & Company for a long time, had said, listen, AIG likes people with your background. And for me, diversification is about a few things. It's about geography. It's about line of business, so property insurance, casualty insurance, aviation, different kinds of things. It's about insurance business and a reinsurance business.
Welcome back to NYSE TV Live, everyone. I'm Kristen Schuller here in the studio at the Stock Exchange. Well, in just a few moments, NYSE-listed Olin Corporation is going to celebrate the opening bell, and Trinity Chavez is on the trading floor with more. Trinity, it's good to see you.
And the crowd is really gathering right behind me, Kristen. Olin Corporation has a long history also with the New York Stock Exchange, one of the longest actually, of more than 2,400 listed companies here on the NYSE. Olin is the 21st longest listed companies, debuting on the NYSE in 1917. The whole team is up there on that bell podium getting ready to open up the U.S. equity markets. We're actually about 8 seconds out from that. Millions from around the world are tuning in, and so let's tune into that and catch you on the other side.
All right, we are officially open for trade here at the stock exchange. The stock market on the move. We're looking at fractional gains across the board. Comes after a few down sessions. Markets just taking a breather after what's been a very strong post-election rally. And of course, the inflation data in keen focus this morning. So joining me now to break down the inflation data and, of course, the levels that we see in equities is Mark Newton. He's head of technical strategy at Fundstrat Global Advisors. Mark, great to have you on the show this morning.
Likewise. Thanks, Kristen.
And let's talk about what we see taking shape in the equity market this morning on the back of inflation.
Well, equity futures are mildly higher. That's a good thing, as well as yields have pulled back a bit. The CPI reading at 0.3% was interesting in that it came in as expected, but yet shelter came in much better than expected. Owner's equivalent rent as well as used cars. Those are two things that honestly give the Fed a lot of confidence that inflation is continuing to go in the right direction. It also basically solidifies the fact that they will cut 25 basis points next week at the meeting, because those odds have risen now to over 80%. So look, the Fed is on track. The economy, despite a few things, evidence of weakness on the fringes, is still remarkably robust. And so I think that's the important thing for the Fed to concentrate on. And they still have that leeway to be able to cut.
What else does the data show you about the state of the stock market and the path forward?
Well, look, the market's had an incredible run this year. We're up. We've had the best year in an election year going back over 40 years. So that is remarkable. But what's interesting is that it hasn't been completely all technology driven. There's been a lot of sector rotation that a lot of people have been talking about. And the month of December in particular has been a little trickier after gains of 26% this year. So we started out from July and technology largely went sideways while these other sectors had been showing very good strength. So from my perspective as a technician, it's actually encouraging to see the last 3 months of data where financials, industrials, discretionary, all up more than 10%. That provides a solid breadth backdrop heading into 2025. So, my thinking is the economy, is on pace still. We haven't seen sufficient evidence to think that we're going to have a big downturn. There is some slowdown in hiring, but the bottom line is the wage growth doesn't support the idea of inflation starting to rise. With crude oil continuing to fall, demand issues out of China, the U.S. potentially set to cut energy prices in half with the oil infrastructure. Rebuilding U.S. infrastructure, that's going to cause crude to have potentially a big decline on U.S. supply. So those things actually are pretty deflationary heading into next year. That would offset, I think, a lot of the rhetoric regarding potential Trump tariffs causing inflation to skyrocket. If anything, the opposite has happened since the election. Yields have actually fallen. The dollar has fallen, which has been pretty much the opposite of what most have been talking about.
Mm-hmm. You mentioned that market breadth has been expanding, and I think for many market watchers, that's something they had been waiting for after technology had largely driven a lot of the gains that we saw during the first 2 years of the bull market. Can that breadth continue to expand?
Well, I'm pretty optimistic, at least initially for the first half of next year, based on what's happened in recent months. I think small caps could start to kick into gear. That's been something everybody's watching. We've seen a breakout in the Dow Jones Transportation Average back to new all-time highs. That hasn't happened in 3 years. That should be very encouraging for industrials. So, some of these sectors have gotten short-term overbought, but I still think there's reason to be optimistic. Junk bond yields, we're seeing record tights in spreads. That's really important in regards to, signs we want to look for to suggest that things aren't as good. So no evidence of any, issues with the bond market at this time. Sentiment, although it has, to some extent gotten a little more optimistic, is still not at extremes.
Mm-hmm. How do you look at U.S. stocks versus international equities?
Well, the U.S. is really experiencing this rally of exceptionalism, U.S. exceptionalism, and I think that we've really dramatically widened out the spread between the U.S. And Europe in recent months. It's been one of the largest gaps of outperformance in the U.S. in years, along with really the rest of the world. So at least the rhetoric was that as the president-elect takes control, and that should put some upward pressure on the U.S. dollar, that'll cause flows back into the U.S. And so we've seen the U.S. and particularly the Mag 7, many of these companies have helped our lives for the better in many ways. They're continuing to show very, very good signs of strength, and that's a good thing. So I still favor the U.S. Eventually as the dollar falls, that could support maybe a temporary bounce in emerging markets, but my thinking is that should prove temporary.
Mark, great to get your insight here, especially as we see the stock market on the move today in the wake of that inline inflation report. That's Mark Newton, head of technical strategy at Fundstrat Global Advisors.
Thanks, Chris.
All right, well, in some other news, NYSE-listed energy company GE Vernova is making new headlines. Trinity Chavez is with the company's CEO. Trinity.
Hey, Kristen, that's right. GE Vernova is driving innovation in the energy sector. From recent big announcements to tackling trends like AI-driven electricity demand and nuclear advancements. To talk more about it is Scott Strazik. He is the CEO of GE Vernova. Hi, Scott.
Thanks for having me. I appreciate it.
It's great to have you back here at the exchange. Now let's talk about the major news announcement that you wanted to share with us on NYSE TV Live.
You bet. I mean, we had our second investor update of the year yesterday after our spin on April 2nd, and we were really talking a lot about how the markets are accelerating on many levels today. I mean, the world needs electricity, and GE Vernova is very well positioned to serve that, both with increased demand for both grid equipment and gas turbine capability that's led to us taking our revenue projections up from mid-single-digit revenue to high single-digit revenue. At the exact same time, all three of our business segments are expanding margin, and we're generating a lot of cash. So that's why yesterday we announced our first dividend effective Q1 25 and a $6 billion stock buyback program.
Amazing. And what would you say are other big headlines, other news that are coming out of GE Vernova?
Well, we are also investing in the long term today. So we talked a lot about the $9 billion we're going to invest in the next 4 years in both R&D and CapEx to serve this market. We spent time talking about long-term technologies like small modular reactors and the role nuclear is going to play. Our grid software business and the role that's going to play in the world going forward, along with things like carbon capture that will ultimately attach to gas turbines in the decades that follow.
AI and data center electricity demand are huge topics of conversation right now, especially in this sector. But how would you say this is impacting GE Vernova's overall business strategy?
It's becoming a clear market opportunity for us. Yesterday, we talked about the fact that we've secured 9 gigawatts of new gas reservation slot agreements for new gas turbines that are very closely tied to the hyperscaler AI demand. And we think this is just the beginning of what's going to be a huge market opportunity for us. This year, we also do a lot of electrical equipment deals with the hyperscalers. We'll do over $500 million of orders on things like transformers and switchgears. So we're just getting started, but there's a lot of opportunity ahead.
Can you elaborate a little bit more on the nuclear side? How is the progress going in the pace in which GE Vernova is expanding?
There's multiple opportunities. It starts with the fact that we've got 65 plants in the U.S. right now running with our equipment. That we have opportunities to uprate and very quickly this decade provide multiple gigawatts of nuclear electrons to the grid. By the end of the decade, we'll have our 300 megawatt small modular reactors commissioned with our first plant in Ontario, Canada. And in the next decade, that's going to become a material part of GE Vernova and a more material part of the new energy capacity that's being built in the country and the world.
And 2025 is just around the corner. What would you say are some of the biggest things that you're looking out for when it comes to the overall electricity space?
Well, we really have to continue to focus on fulfillment. I mean, we've got the markets coming our way. We've got a growing backlog. Our equipment backlog is up 50% in just the last 7 quarters. So our focus right now is ramping up that fulfillment while doing it in the safest, highest quality way that we can.
And I want to know more about how you're supportive of sustainability and the renewable energy integration.
You bet. I mean, when we talk about sustainability, we talk about both electrifying the world and doing it in a cleaner way every day. And that's when we talk about the carbon intensity of our install base in totality. We can do that by applying zero carbon technologies to gas with things like hydrogen and carbon capture. We'll grow our wind business over time. We generally have about half of the market share with onshore wind in the US as an example, along with things we talked about like small modular reactors.
Yeah. And you know, there's a lot of things that are impacting markets that are happening in our world. We're seeing a new administration take shape in January. Talk to me if that's impacted your business in any way and how you're addressing those challenges.
Well, when I hear the administration talk about energy strategy, they're talking very much about an all-the-above technology strategy that GE Vernova is very well equipped to serve. They talk a lot about U.S. innovation, U.S. competitiveness, using energy security for national security. Those are things that motivate us, both for the U.S., but to export that technology for economic development in the world and, frankly, for peace.
Key priorities for 2025?
We'll have our first full year as a public company. We've got real opportunities to serve this market. It starts with safety and quality, continue to use our growing cash balance in shareholder-friendly ways. We've got a lot to look forward to.
And I'm sure more news announcements down the line. You'll come on the show and join us more.
We look forward to it, Trini. Thanks for having us.
Thank you, Scott. It was a pleasure.
Very good.
Now we're going to take a quick break, and right after we're going to take you live to the United Arab Emirates, where this year's Abu Dhabi Finance Week event is underway. So stick around. You're here at the New York Stock Exchange for our annual Space Summit. This is your first year attending. Talk to me about why it was important for you to attend.
For decades, space was not really talked about, and particularly in the world of investing and early stage investing, it was not a smart investment to make. It was not, viewed as salient or viable given the long time horizons, the capital intensity, and that is all changing. So all of the work that the industry has been doing behind those closed doors, behind the curtain, is now coming to fruition. And so the best time to make these investments, especially in early stage, is just before something is about to happen and having that timing exactly right. And so that timing is now.
Talk to me about, from your standpoint, the criteria in which you consider before deciding who you want to invest in.
The fact of the matter is 776 is a generalist firm. And so this is not our deep area of expertise. We are an inch deep, a mile wide across different sectors, which is a beautiful position to be in, to really understand how all of these economies fit together. And for me, the interesting thing about space is that they're actually creating their own new economy. And so the in-space economy for me is wildly fascinating. And the opportunity, from an investment perspective is massive. And the opportunity and the capabilities that this is going to breed for us here on Earth, for humanity, the human side of this is absolutely fascinating for me. And so we typically make one moonshot investment per fund. And so we're relatively new to the space as investors, to the sector, I should say.
Yeah,
the sector of space, yes. and so I'm really here to learn. I'm here to understand what people are talking about, where the industry movers and shakers are. But the deeper I get into this, the more and more obsessed I've become.
And where would you say the different areas in space are you targeting right now?
There's a lot of...
Good morning and welcome back to NYSE TV Live, everyone. I'm Kristen Scholler in studio. Well, when you think of Abu Dhabi, you might consider its presence in the global energy space. For the past few decades, oil has been the main driver of Abu Dhabi's economy. Recently, though, the Emirate is looking to move beyond energy, diversifying its economy through new technologies, including in the financial space. And for more, I want to send things over to Trinity Chavez.
Thanks, Kristen. So Abu Dhabi Finance Week is in full swing, and it's bigger than ever before, doubling in size this year and drawing major names like BlackRock to the region. Now, to talk more about what's driving this incredible growth and the positioning of Abu Dhabi as a global financial powerhouse is Chris Hughes. He is the editor-in-chief and executive editor of Abu Dhabi Finance Week. Thanks for joining us, Chris.
Hello, thanks for having me. Good to see you.
Now, this event has grown significantly this year, doubling in size. What do you think is driving this rapid expansion, and how has Abu Dhabi Finance Week evolved since its inception?
Yeah, it's a very good question. Listen, the growth of this event is pretty correlational to the growth of the global interest that we're seeing in Abu Dhabi as an international financial center. It's growing really quickly. It's in the press every day. I'm sure you've seen it. We have went from 290 speakers this year to 650. And you know, it's just one of the biggest global gatherings in the world now. But again, very correlational to the growth of ADGM and Abu Dhabi as a financial center.
And you recently interviewed Larry Fink, and we saw that compelling conversation as just a part of day one. Talk to me about what some of the key takeaways were from that discussion with him, and why is BlackRock's presence there so significant?
Yeah, like Larry Fink's an incredibly interesting human being, brilliant mind. It was a pleasure to interview him. We talked about a whole range of things. He was primarily speaking about the sort of investment attractiveness of Abu Dhabi, the rise of the Falcon economy. Abu Dhabi is a capital of capital. He talked a lot about, you know, the influence that artificial intelligence is going to have on financial markets in the next while. You know, these are the big issues. He also announced a setup of BlackRock in our financial center. It's the first time they've set up here. We're very, very happy to have them. World's biggest asset manager setting up in the capital of capital. It makes a lot of sense, and it's great to have BlackRock here.
And Chris, as you mentioned, Abu Dhabi is really becoming a hub for global financial players, with companies like BlackRock establishing their presence. So what makes Abu Dhabi, though, an attractive destination for these major firms?
Abu Dhabi for decades now has been primarily an exporter of capital. We have 3 sovereign wealth funds. I think statistically they work out recently that it's the richest city in the world for sovereign wealth fund capital. So historically we've been a net exporter of capital. Now we're seeing, particularly in the past 2 years, this huge demand to invest in our economy. You know, just this week we've had asset management firms representing nearly $1 trillion announced setups in Abu Dhabi outside of BlackRock. You know, a whole bunch of private equity firms, private credit firms, hedge funds, venture capital firms. We have new fast-growing tech firms that are based here, that are being funded to scale up their operations. It's incredible. It really has been. It's been quite a few years, I have to say, and we're really, really excited about everything. So things are changing here. It's the Falcon economy. Come and see it for yourself.
What would you say are specific themes or discussions that you're most excited about this year compared to years past?
Yeah, like, you know, Finance Week's a great global gathering of hundreds of financial leaders from hundreds of countries around the world. They're here to talk about one thing and one thing only, and that's 2025. We're in December 2024. The year's starting to come to an end. It's everyone's looking to what's going to happen next year. There's a lot going on in the world. Everything from the new administration in the United States and what that means for the global economies, the rise of the global south as an economic power center, global regulatory cooperation on artificial intelligence, climate finance has been a very big topic. We've had a huge market announcement today between Circle and Binance. So Circle are now going to list USDT on Binance. We're talking about risk and security. We're talking about Islamic finance. You know, we're talking hundreds of different topics. So this is why there's so many people who come in 2025, and it's going to be a big year.
Chris, I'm getting some interference with your audio right now, but we look forward to continuing these discussions as the Financial Week in Abu Dhabi wraps up. I'm sure we're going to be discussing this for many weeks to come. Thank you again. That's Chris Hughes. He is the editor-in-chief and executive editor of Abu Dhabi Finance Week. Now coming up, German-based tech company Northern Data just announced its latest move in the U.S. So stay tuned for those details.
So now, Chris, tell me about the MLS Innovation Lab program and what it means for Major League Soccer.
So we launched Innovation Lab last year because, MLS has always been at the very forefront of innovation. We were one of the first leagues in the world to launch automated review. We, have our global media partnership with Apple, but we never had a formal innovation program. And so we thought this would be a great opportunity for us to take all the energy from our league, our clubs, our youth leagues, and centralize it and build one central program that we call the Innovation Lab. We see hundreds and hundreds of companies apply every year, and we select the best 6 or 8 to work with us on a 9-month program where they get to really test and try out their technologies. We get to spend time with amazing young founders, and together we get to build the future of sport in North America.
Now, when it comes to evaluating companies to invite to participate in the program and for MLS to potentially invest in, what are you looking for?
Of course, it always starts with what's the idea? Does this founder have something we think is compelling that we can actually use in MLS or in one of our academies? And so that's the starting point. What's the technology? What's the product? And is it interesting to us? And then we do all of the normal things. We spend time with the founding team. We understand, what their vision is, who they are as people. Finances of the company, of course, matter. And then we evaluate all of that, and we go through a deep screening process, lots of cuts, and then come up with the final couple companies.
And tell me, what have been the biggest learnings so far from the MLS Innovation Lab? And personally, what have you enjoyed the most?
So the best is spending time with founders. I mean, you get to do it every day. The energy that startup founders bring is just incredible. Their ingenuity, their drive, their passion. I would highly recommend for any CEO, any executive, to go get out of your office and go spend time in the startup world and bring some of that energy back to your company.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio. Let's take a quick check of the markets. We see gains across the board, fractional gains. In fact, there's a live look at the Dow Jones Industrial Average. It is after an inline inflation report for the month of November, and traders upping their bets that the Federal Reserve will move forward with another 0.25 percentage point rate cut at its decision next Wednesday. Inflation did tick a little bit higher last month, but still the trend over the past 2 years has been a move lower. All right, let's talk artificial intelligence. Earlier this month, Northern Data Group, the world's second largest AI platform and Europe's biggest AI provider, announced that it will be expanding in the United States, building a new data center in Georgia, just about 70 miles away from Atlanta. Well, joining me now with more is Roseanne Kincaid-Smith. She's Northern Data Group's COO. Roseanne, welcome. It's great to have you.
Thank you for having me.
I'd love to learn more about your expansion into the U.S. and what it means for business.
So Northern Data is essentially a AI solutions and high-performance computing business. So we provide that very specialized GPU-based infrastructure, but we do that on a vertically integrated basis. And that's why our expansion into North America is so important for us, because not only do we provide the GPU-based infrastructure, but we house that in our own innovative data centers. And so that's part of us expanding our global data center footprint so that we can do more with AI-based infrastructure and also contribute to the local communities here.
I want to hone in on some of that data, Roseanne. The generative AI market we see expected to reach more than $1.3 trillion by 2032. How is your company poised to partake in that?
So we've actually been on our journey towards being an AI solutions provider for quite some time. But what a time to be alive at the moment. I mean, there is infinite opportunity in the AI solutions space, and that's why our business model has evolved in the way that it has, because we don't just provide the infrastructure, we complement that with the type of services that help our customers to bring their AI applications to life. And so we really do live and breathe by our strapline, which is innovation bravery, which means we put all of our resources behind the things that we believe in, and AI and the impact that it'll have on society is one of those things.
We cover AI and NVIDIA a lot here at the Stock Exchange on our program, of course, airing each weekday. And I know your company, Northern Data Group, is one of NVIDIA's as key selective partners. How is that helping your firm accelerate AI availability and capacity?
Being part of the NVIDIA ecosystem has been a great accelerator for our business, and particularly being an elite partner has meant that we've been able to access some of the newer technologies really quickly. So in addition to being an elite partner, we were also announced as one of the Grace Blackwell partners, and that again is very inherent in our business model because we provide liquid-cooled infrastructure, which means we are already primed to bring that new NVIDIA GB200 infrastructure to markets.
And I want to talk more about that, the sustainability aspect of all of this, because you've been mentioning global data centers. We know that that demand is expected to double by 2030. What are the strategies that Northern Data Group is putting in place to ensure that that increasing demand can be met in the cleanest way possible?
The ethos of our business has long been held on sustainability. So right from our inception, right through to now, we've been very focused on making sure that we run on carbon neutral energy. So we favor hydroelectricity, for instance. And part of the reason we innovated with directed chip liquid cooling is to continue to provide that very, very safe space for our planet, but also to provide more efficiency in our data centers. So with that expansion comes more accountability in doing things the right way.
How are you working with younger companies to mentor them, to provide them some of the support that they need to be able to thrive in this environment as well?
I'm so glad that you asked that. It's definitely one of the most important parts of our business. Of course, as a commercial business, we love to expand our ecosystem, but it also allows us to do things like run what we call our AI accelerator. We invite startups from the community who are focused on bringing AI applications to life, but might not have the right cost of capital to actually get access to this infrastructure. So we actually invite them into our ecosystem. They use our infrastructure completely for free, and then we also provide mentorship and engagement strategies to help them to raise capital and find new board directors.
I saw a beautiful film that your company released called The Glass Hermit. How is AI at play there?
So AI is actually a medium in the film, and we're really proud of this piece of work because ultimately it speaks again to our ethos around making sure that AI augments human capabilities. And with all of the cynicism and skepticism around will AI be an influence for good or will it be an influence for bad, the creative industry is one of the industries that I think has been the most skeptical. So we engaged with Shona Heath to bring that AI medium into her filmmaking, and what we've created is something really special and unique, and again just demonstrating real innovation, bravery, and making sure that AI is viewed as something that would be extremely positive in the world today.
I like that term, innovation, bravery.
Yeah.
Roseanne, such a pleasure to have you. Thank you so much for joining us, of course, here at the New York Stock Exchange. That's Roseanne Kincaid-Smith, Northern Data Group COO.
Thank you very much.
All right, well, as we are winding down the show, I do want to bring in my colleague, Trinity Chavez. Trinity, of course, a lot of action on the trading floor and in markets this morning. What are you watching?
A lot of action right here on the floor. I mean, the traders are head down right now as they are responding to the market open that just happened a little under 30 minutes ago. The crowd, though, is dying down a little bit behind us as CNBC's broadcast is still underway. But, you know, we had an action-packed show, Kristen. It was great, the great interview that we just heard from you. But, you know, we're going to be looking out for a lot as we see the coming weeks come to a head.
Yeah, it's interesting, of course. Artificial intelligence is something you and I have been covering for a long time, and to hear from different guests throughout the show about the innovations that they're seeing, of course, and what's ahead in 2025 has been fascinating. Trinity, after a breather in the stock market, we see stocks higher today, and that's going to do it for today's show. For Kristen Schiller, Trinity Chavez, and our team, thanks for watching.
I'm reminded that it's not about the destination, it is truly about the journey.
My pleasure to greet you today from the center of the U.S. capital markets here at the New York Stock Exchange.
I want to just take a minute and not just talk to the people that are in the room, but I want to speak to the rest of the team around the globe. These are people that made this happen, and I know that there is no way we would be here if it wasn't for you.
Everyone at Flutter is proud to join such a distinguished list of companies on this great stock exchange.
Not many people get to do something big in this world, and we get to do something truly special.
This is such a wonderful place to both look back and look forward. Look how far we have come. I'm so optimistic about what lies ahead. It has been a privilege to be with you.